we're good to go.
Okay. Welcome to today's webinar on the topic of the Employee Retention Tax Credit. Part of our business education series, we welcome Jim Oradaka, a partner and co-founder of Savant Payroll Solutions. If everyone could mute their mics, which I think they probably already are, there will be time for Q&A. You can either put your questions in the chat box, or Nathan tells me that he can make mics live so you can actually ask your questions if that's easier. If you miss any details, don't worry about it. We're recording today. It will be on our website and we will share the link. Jim, take it away.
Great. Thank you so much for the introduction and certainly the opportunity to speak to the members of the chamber. So as Wendy said, what we want to talk about today is the Employee Retention Tax Credit Program. It was part of the stimulus package that was passed at the beginning of this year. And the focus of it is really to offer economic assistance to businesses, regardless of what arena you're operating in, who are affected by COVID restrictions in terms of whether it be a complete shutdown, restriction in capacity, anything COVID associated that limited your business operations, that would make you eligible to participate in this program, okay? So we've been doing this for not only our current client list, but also other businesses really throughout the country whose CPA or other payroll company doesn't really understand the program or just doesn't want to have anything to do with trying to capture the incentive. So you don't have to be obviously a client of Savant's to take advantage of this. We have a system in place operationally to maximize these opportunities. So it's really a windfall. I mean, we're seeing upwards of 7 figures in tax credits for some of our clients. And even though it's a tax credit, it's not in the form of your traditional tax credits, which usually reduces the tax liability. This is actually a refundable tax credit, and what that means is you will actually get cash or checks, direct money from the IRS. So, it will really help those businesses who, struggled in terms of generating revenue due to COVID, and obviously in the future, because as I said, and Brian will touch on this a little bit more in detail, the amount of money that is available for you, regardless of your size, regardless of your industry, is pretty significant. So, talk a little bit more about the program in terms of how we capture these credits. Brian Keeney will jump in here. He works for Savant as well as the Hudson Group, which is kind of our tax credit wing here at Savant, and specializes in the tax credit space. Without further ado, I'll let Brian take over.
Hey, hope everyone can hear me all right. So as Jimmy was saying, I mean, the ERTC was created as a way to help those businesses who are struggling due to COVID or have some sort of government restriction due to COVID that would limit their commerce. So a good example of that would be restaurants that could not operate at a full dining room as far as capacity. So a limit put by the governor saying you cannot have your full dining room open for X amount of time is something that would qualify a restaurant. So like I said, there's a couple ways to qualify. As far as the revenue loss side of things, there's different parameters for each year as to what qualifies a business. For 2020, what you want to see is a business whose revenue went down 50% in a quarter when you compare that quarter to the same one in 2019. And then in 2021, it's a 20% revenue drop when comparing the quarter to the same quarter in 2019. Happy to talk to people on a more individual basis about that because it's a little more nuanced and sometimes a little hard to explain exactly comparing the quarters to quarters on a webinar, but I'm happy to talk to whoever wants to talk about that. The government restriction one is a little more broad. Like I said, restaurants qualify more generally just because they were limited in commerce by government orders pretty widely across the country. But I'm sure there are many other businesses that will qualify that way depending on what type of government restriction you had on your business. Obviously, as a business owner, you would probably have a much firmer grasp on how the government restricted yourself than I would, just from knowing your own business. But the other thing to touch base on is kind of the amount of the credit. As Jimmy was saying, these add up pretty quick. For 2020, the credit is 50% of the first $10,000 in wages per employee. 2020 is a little convoluted with PPP money because you can't take both on the same wages. That's part of what we do, is we figure out exactly what wages are eligible, which ones are ineligible, so we can kind of create a full picture. But obviously, if you have somebody who earns 10 grand ineligible wages, their credit would be $5,000 for 2020. When you start adding that up across a number of employees, obviously that adds up pretty quick. In 2021, the credit changed, so now it's 70% of the first $10,000 per quarter. So where 2020 was for the whole year, 2021 is going to reset each quarter. So quarter one, each employee who makes 10 grand that it has eligible wages would be a $7,000 tax credit. Again, if you get a decent amount of people maxing out this credit, it adds up very quickly. So obviously you can see kind of the large benefit. As Jimmy was saying, on the claiming it standpoint, it's not like a traditional credit where it goes in your return at the end of the year. It's actually claimed on your 941 each quarter, your payroll return. There are other ways to claim it in advance, but that's kind of the most cut and dry way to explain it. So it usually happens at the end of your quarter. You get your 941 filed. It is usually, if things go well, pretty close to balancing out, maybe a few pennies off. So what will happen is the credit will show on there, and instead of balancing out, you'll show an overpayment in the amount of the credit. And what will happen is the IRS will then send a check in that amount to the address on the 941. So obviously you're getting the money back as a check. At that point, you're losing the wage deduction, so you're paying taxes on the check, the revenue you're getting back or the income you're getting back, but there is still a very large net benefit. Happy, like I said, to talk to people on an individual basis. The important thing is to figure out, one, if you have a government restriction, that's a great way to qualify, or if you had one last year, and two, if you have that reduction in revenue of 50% a quarter in 2020 or 20% here in 2021 from the same corresponding quarter in 2019. So if anyone wants to reach out and kind of talk further, I'm happy to do that, just because it's a little nuanced and each situation is different, and we like to take a personal approach to get to know exactly how each business was impacted. Shoot it back to Jimmy here.
Yeah, to kind of piggyback on that a little bit, we've done work for a lot of businesses who were either told by their payroll company or their tax preparer CPA that they didn't qualify. And, they were curious, so they, did their own diligence and came to, Savant and said, I was told I didn't qualify. What we did was we did a comprehensive analysis of the payroll and determined that they actually did qualify. So, even if you're being told, or even if you think, I didn't qualify, maybe you're a fast food restaurant and you only had your dining room closed, but your drive-through window was open and sales may even be up. The reality of the situation is if your dining room was closed, regardless of your sales, you're still eligible to participate in this program. And the other part is the fee structure that we have is completely success fee based. What I mean by that is we don't charge an analysis fee. There's no upfront cost to secure our services. What we'll do is when we get the payroll data and we do our analysis, if we find you something, we charge 10% of whatever we find you, okay? If we don't find you anything after the analysis, you don't pay us anything. So it really is a risk-free endeavor. And as Brian said, and I know I touched on briefly at the beginning, it is a very lucrative opportunity for any business out there.
I don't know if there are any, I don't see any questions in the chat. Nathan, do you want to come back live so we can see if anybody has questions? Can't hear you, sorry.
So someone just raised their hand, so I will allow them to talk and come in. Let's see. They should be able to ask their question now.
So, hi.
Hi.
Can you hear me okay? Hi.
I can, yeah.
This is Deb from Michael Timothy's Dining Group. We just had a question on the qualified health expenses that go with the ERTC. What is that exactly, and what can you submit for those expenses?
Okay, so as far as qualified health expenses, what that is medical premiums you pay as the employer, so your portion. So for that, usually what happens is we figure out if we usually do the wage side first, because the whole credit cap's at 10 grand between wages and the medical. So if a lot of times, depends on the industry, but a lot of times if you're getting health insurance, you're a higher paid employee. Obviously not always the case, and 10 grand a quarter, that's opens up a lot more people to that version of the credit, or that side of the credit. So what happens is if they don't make 10 grand, we look into the health insurance premiums the employer pays, and the medical only, not dental, not vision, just medical. The side you guys pay, you can get, it's still the 70%. It's just coded differently in payroll systems, and it's a different line item on the 941, but it's still the same credit percent. It's still at 70% in 2021, 50% in 2020.
Okay, so I thought I had read somewhere that it was the employer and the employee portion, but you're saying it's just the employer?
Yeah, because it's the portion you're paying.
Okay. Anything else? I guess that was it.
Actually,
well,
we have one more question, if you don't mind.
Absolutely.
We still on speaker?
Yeah, I can hear you. I'm sure.
Okay.
I hear you.
So when it comes to the government restrictions that would qualify restaurants, obviously our understanding is, like, if the capacity itself is limited via a 50%, 75% capacity limit, that would qualify. Does the spacing restriction that impacts the amount of people that you're allowed to have in your dining room, would that qualify as well, saying that you have to have 6 feet between tables, 6 feet between bar seats, and therefore you're only able to seat, whatever that number ends up being, 70, 75% of your dining room via spacing restriction?
Yep. So basically it does. It's essentially, you're trading a cut and dry percentage for a reality based. If you're spacing people, you're losing seating. It's not, you can only have 50%, but it's spaced 6 feet apart. You can't be fully open. Right. If you were to go on the IRS guidance and like frequently asked questions on the IRS site, a very exciting place. I recommend it highly. You'll see as some of the examples on there, one of them is, is 6 feet of separation a qualifying, a limit to my capacity? And it'll kind of go through a lot of different examples, but for that particular one, it'll say yes, because like you said, I mean, if you have spacing out bar seating, especially, is pretty cut and dry. You're going to lose 2 or 3 seats in between parties. And at that point, you're being restricted by the government. So yeah, the short answer.
And so that would work for 2021 as well, as long as up until the point that the governor says there's no more spacing restrictions.
Exactly. Yep. So as long as they are in place, then you're qualifying under that particular set of rules. And yeah, it all depends. I mean, some restaurants are different. I like to take that particular situation, not as broadly as the 50% capacity one, because that's obvious. It applies to everybody. But if I talk to a restaurant that says, honestly, 6 feet, I was still fully open, then I, due diligence wise, like to talk to them a little more like in depth to figure out, if that's something we can take at face value, or if, they're kind of still eligible, but not thinking they are. But as a general rule, when you're starting a space like that, it's fairly difficult to open 100% and not lose seating.
Right. All right. Thank you.
Yep.
Looks like there's a question in the, if you want, Jim, can you see those questions? You want to go and read those?
I can, yeah, I'll read it out. Yeah, so it says, this is from Lori. We have a unique situation where we are an off-premise caterer. So we have been subject to limitations in gatherings throughout the pandemic. If the sizes of gatherings has changed over time, do you think this would still qualify?
So I would be interested from a standpoint of revenue.
Yeah.
If you were down still. I'm not saying you couldn't qualify on the other one. That's just a little more nuanced, and I would probably dig into that particular situation a little bit on a research side of things, because I just haven't dealt with that particular situation. But like I said, I mean, there's the revenue side and there's the government restriction side of things. I think you have, I mean, obviously on the revenue, that's a little more cut and dry, but on the restrictions, I would be talking with some other people here to go back and forth and kind of come up with a consensus on that one, but I'd be happy to do so.
We actually have another question from Donna, who's over at the Dover Chamber. It says the ERTC instructions that I found says A, decline in gross receipts in a calendar quarter in 2020, where the gross receipts of that calendar quarter are less than 80% of the gross receipts, and that same calendar quarter in 2029, quote, in parentheses, to be eligible based on a deadline in gross receipts in 2020, the gross receipts were required to be less than 50%.
I think Donna kind of answered her own question because she realized that was for 2021, not 2020.
Yeah.
So like I said, 2020 is 50%. And all you really need is one quarter that's 50%, because you qualify for every quarter after that until you're back up to 80%. I know it gets a little convoluted, but for 2021, if you're down 20%, you qualify, which is where you see the 80% there. And you qualify until you're at 90%. So the restriction or the limits were definitely raised this year. So more people will qualify in the current year based on the reduction in revenue versus 2020. But that wasn't retroactive when they changed it in 2021 to apply to 2020.
Again, I know that it's not here on the slide that we're looking at, but I believe Wendy will make our contact information readily available at the conclusion of this. So if there are any questions or need further explanations, especially with Lori and her question, the number will be shared to give us a call, and we can set up time to talk through that.
So we can, when we send out the recording of the video to everyone, we will have your contact information on there.
Perfect.
I do have a quick question. In reading this, are nonprofits included in this that were, basically shut down because we weren't essential businesses? And I'm talking about 501(c)(3) C3s, but then later on the C6s, we were eligible for PPP in the second round. So I'm just curious if we are included in this and able to apply if we retain employees.
So I'm going to talk with the other Jim in our office about that, because he's been handling more of that side of things. I am fairly certain you are, but I don't want to get out ahead of myself because I focus a lot on restaurants specifically, so I don't want to get out of my specific lane. I mean, generally speaking, most nonprofits or most for-profits I can help just from my own understanding, but I don't want to falsely say yes. So I can definitely get back to you on that one.
We haven't, we don't deal with any nonprofits, so that's not really what we've tried to kind of master the inequities of the program. But it's a great question. The first time it's been proposed to us, so we'll figure that out and definitely share that information with you.
Thank you for that. Is there another question in the chat, or we already did that one? Can you think of any other scenarios, Brian and Jim, that would be the types of businesses that aren't on this call today, but, besides restaurants and I don't know if retail is kind of part and parcel with this.
Sure.
Yeah, I mean, I think like I tried to, and I don't want to say it's a cop out, but I try and make, you all know your businesses better than we do. And you know how the pandemic impacted you from both a government order standpoint and financially. So just off the top of my head, hair salons, I don't frequent them, but I believe they had some restrictions. My wife still was able to cut my hair, but they definitely had restrictions of who they could see. They were closed down for a while, that kind of thing. So if you take an introspective look at your business, you know what applied to you. You know if you're fully open. A lot of smaller shops, like downtown Nashua there, would qualify because they can't have full entry into their stores. So even if you're not a restaurant where your spacing is 6 feet apart, at some point in this whole ordeal, you had a limit on how many people could enter your store at one time. It doesn't matter if that was never really a concern for you because you're a small mom and pop that only ever has one person in it at a time. At the end of the day, if the government is restricting what you're capable of, you're lowering your ceiling, you would qualify under that. But it has to be a government restriction. So some poor advice out there that I've heard is we deal a lot with franchises, and the corporate entities can enforce their own rules. And so for some of them, they don't want you open your dining room unless your geographic area meets certain COVID testing limits. So 5% positivity rate or lower, you can open, etc. But that's not a government restriction. That's a personal choice. So if you as a business is saying, hey, I'm just not comfortable on your own accord, that wouldn't qualify. If you as a business are being restricted and are still on that fence of like, I don't feel good, you do qualify. Because even if you don't open, even if you were opened, you wouldn't be able to do what you do in the way that you normally do it. So it's just that government restriction being in place, if that makes sense.
Yeah, another good example, we actually recently engaged with a for-profit school that has locations throughout the country. Obviously, there was restrictions and kids going to school and whatnot. So, I mean, if you're a for-profit entity in any industry, and you were affected by this, like Brian said, it's worth having the conversation. At the very least, they came to us and they said, well, we're education. I thought we qualify for this, blah, blah, blah. Well, when we peeled back the layers of the onion, the reality is they're a for-profit educational group and they do qualify. And the credits that they're going to receive from this are going to be pretty significant. So a 5-minute conversation could be worth, several $100,000. And I'm not exaggerating when I say those numbers.
To even put it in like even more like oddly focused area, we're doing swim schools in different states because they couldn't operate normally and the class sizes had to be smaller, and there were periods where they couldn't have anybody because it was obviously swimming lessons were not an essential business for a while. But even now, where this particular group is located in Michigan, you can't operate how you normally operate because you're getting restricted. So it definitely touches a lot of different businesses. It's not just restaurants. I work a lot with restaurants. That's why I kind of focus on it. But like I said, if you have a feeling that you have a restriction in your business by the governor or even more local government on the national level or wherever, if you're in a surrounding town and a member, I'm not sure how far you guys extend, but those would qualify. So it's all about the government restricting you in that aspect of things. So there's still always the revenue reduction one. I know some industries were definitely hurt a lot more than others. And even within industries like restaurants, again, in particular, we do a lot of fast food. They're not really financially hurt as bad because they have DoorDash and they have drive-throughs. So they're kind of carved out from that side of things, but they're still restricted. And then you got a regular restaurant who's kind of hurt both ways. A sit-down restaurant, if you go into them today, like I went to Not Your Average Joe's not that long ago, and it was definitely a lot easier to get a table just because of the amount of people there than it normally would be. So it's a broad-based and broadly touched group of people and businesses. So definitely, if you feel like you may qualify, err on the side of, okay, I'm going to call these guys, because it's really, like Jim said, it's not a long conversation to figure it out. If we feel good about your case, like situation or not, as far as qualifying, and maybe we come across some more nuance that we have to discuss within our own company before we take a position on it, like the nonprofit thing, because I'm not 100% on my side, but I'm happy to talk with whoever. Jim loves talking on the phone, so he's happy to talk to whoever wants to call and go over this with them.
Any final questions or final thoughts? Well, thank you both. We will definitely get out all of your contact information. I learned a lot, so I'm sure everyone else did. And I think that the value also in this webinar is how far we're going to distribute it. So hopefully you'll get, as a chamber member, we want you to get lots of calls. So,
we appreciate the opportunity.
Thank you very much for presenting this.
Thank you, guys.
Have a great day, everyone.
You too.